Before we begin, please remember that I am not a licensed financial advisor, and the information in this presentation is for educational and entertainment purposes only. This video is not a substitute for professional financial advice. Always consult with a qualified professional before making any major financial decisions. Your financial situation is unique, and the information presented here may not be suitable for your specific circumstances. The bank you choose for your mortgage could be the single most expensive mistake you ever make. I'm not talking about a few $100s. I'm talking about a decision that could cost you the price of a brand new car, a dream vacation, or even a full year of college tuition for your child, all completely unnecessarily. Most people think they're making a smart choice. They compare a few interest rates online, they go with the bank they already have a checking account with, and they sign on the dotted line feeling like they got a deal. But what they don't realize is that they just walked through a financial minefield blindfolded. They were so focused on the one shiny number, the interest rate, that they missed the hidden fees, the rigid underwriting, the terrible customer service, and the loan structure that was designed to benefit the bank, not them. This is the trap. And it's a trap that costs American families tens of billions of dollars every single year. The system is designed to be confusing. It's filled with jargon, complex paperwork, and a sense of urgency that pressures you into making a quick decision. You're left feeling overwhelmed, underinformed, and just wanting the whole process to be over so you can get the keys to your new home. Well, that ends today. This isn't just another video with the top 5 banks list that's outdated the second it's published. This is your playbook. This is the definitive guide to seeing through the marketing gimmicks and the confusing terminology. I am going to give you the exact framework to dissect any lender, to ask the right questions, and to find the one institution that is perfectly aligned with your financial goals. By the end of this series, you won't just choose a lender. You will strategically select a financial partner. You will have the confidence and the knowledge to turn the tables, making the banks compete for your business, not the other way around. You will save yourself thousands, potentially tens of thousands of dollars, and a massive amount of stress. So where do we start? The first thing you have to understand is that not all lenders are created equal. In the vast universe of mortgage lending, there are really only 3 types of players you need to know about. Think of them as 3 different species in the financial jungle: the Goliaths, the community champions, and the secret weapons. Let's break down the first 2 right now. First up, we have the Goliaths. These are the giant national household name banks. We're talking about Chase, Wells Fargo, Bank of America, US Bank. You see their logos on skyscrapers, on ATM machines on every corner, and their ads constantly on TV. They are the default choice for millions of Americans, and for a few seemingly good reasons. The biggest appeal? Convenience. You probably already have a checking or savings account with one of them. You know their app, you know their website, and the idea of keeping everything, your deposits, your credit cards, your mortgage, all under one roof feels simple and organized. They might even offer you a relationship discount, a tiny fraction of a percentage point off your interest rate, just for being a loyal customer. Their technology is usually top-notch, with slick online portals that let you track your application's progress 24/7. It all feels very safe, very established, very easy. But this is the siren song of the Goliaths. The convenience they offer often comes at a steep, hidden price. These institutions are massive bureaucracies. Getting a mortgage from them can feel like trying to navigate the DMV on a holiday weekend. Your application gets passed from one department to another, and the person you spoke to last week might not even be there this week. You are, quite frankly, just a number in their system, one of tens of thousands of loan applications they process every month. And what does that mean for you? It means less flexibility. Big banks live and die by rigid, black and white underwriting rules set by a corporate committee hundreds of miles away. If your financial situation has any nuance to it, maybe you're self-employed, have a non-traditional income stream, or had a small credit hiccup a few years ago, their computer system is likely to just say no, with little room for a human to intervene and understand your story. Furthermore, their sheer size and overhead, all those fancy buildings and massive marketing budgets, mean their rates and fees are often not the most competitive. They don't have to be. They rely on their brand name and the convenience factor to bring in business. Choosing a Goliath is like trying to get a custom-tailored suit from a mass-market department store. They might have your size, but it's probably not going to be a perfect fit. Now let's look at our second player, the community champions. These are your local and regional credit unions and smaller community banks. Think of names like Navy Federal Credit Union, or maybe a local bank in your town that's been there for generations. Unlike the big banks, which are owned by stockholders and exist to maximize profit, credit unions are non-profit institutions owned by their members. That's you. Their entire reason for existing is to serve their members, not to please Wall Street. This fundamental difference in structure changes everything. Because they're not trying to squeeze every last penny of profit out of you. Credit unions often offer some of the most competitive interest rates and lowest closing costs you'll find anywhere. The difference might look small on paper, maybe an eighth or a quarter of a percentage point, but over the 30-year life of a loan, that small difference can add up to tens of thousands of dollars in savings. But the real superpower of the community champions is service and flexibility. When you apply for a mortgage at a credit union, you're not just a number. You're a member owner. You're often sitting across the desk from a loan officer who lives in your community and whose kids might go to the same school as yours. They have a vested interest in your success. And because they are smaller, they have more autonomy. Many credit unions and community banks are what's known as portfolio lenders, which is a hugely important term. It means they often keep the loans they make on their own books instead of immediately selling them off to a giant investor. This gives them incredible flexibility in underwriting. They can listen to your story. If you're a freelancer with fluctuating income but a great history of savings, they can take that into account. If your credit score is just a few points shy of the magic number for a big bank, a credit union has the power to look at the bigger picture and make a common-sense decision. Of course, there are trade-offs. Their technology might not be as slick as the Goliaths. Their mobile app might be a little clunky. You'll also need to meet their membership criteria, which could be based on where you live, where you work, or your affiliation with a certain group. However, these requirements are often much broader than you'd think, and it's usually very easy to join. They may also have a more limited menu of loan products. They might not offer that exotic, interest-only loan for a multi-million-dollar investment property. But for the vast majority of homebuyers looking for a standard 15-year or 30-year fixed-rate mortgage, the community champions are an incredibly powerful and often overlooked option. So we have the Goliaths, offering convenience at the potential cost of flexibility and price. And we have the community champions, offering incredible value and service, but perhaps with fewer bells and whistles. Most people believe this is where the choice ends. They think they just have to pick one of these two paths. But they're missing the third and potentially most powerful player in the game. They are the secret weapon for homebuyers in the know. They aren't a bank at all. They are a specialist, a market insider, and a personal advocate who works directly for you, with the sole mission of navigating this entire complex world on your behalf to find you the absolute best deal possible. They are the key to unlocking dozens of lenders you've never even heard of, creating a bidding war for your loan. This secret weapon, this financial advocate, is called an independent mortgage broker. And if you've never heard of one, or you've confused them with the person sitting behind a desk at your local Chase or Bank of America, then you are about to have your entire world of home financing turned upside down. Because they are not the same thing. Not even close. Let me put it this way. Walking into your bank for a mortgage is like walking onto a Ford dealership lot to buy a car. The salesperson who greets you is friendly, professional, and knows everything there is to know about Ford cars. They can tell you about the F-150, the Mustang, the Explorer. They can show you different trim packages, colors, and financing options for a Ford. But what if the best car for you with the best features and the best price isn't a Ford? What if it's a Toyota? Or a Honda? Or a Kia? The Ford salesperson can't help you. In fact, it's their job to convince you that you don't need a Toyota, that the Ford is superior, that this is the best and only deal you'll find. Their loyalty is to the dealership. Their paycheck is signed by Ford. They work for Ford. The loan officer at a retail bank is that Ford salesperson. They work for one single institution. They have one set of loan products, one set of underwriting guidelines, and one set of rates for that day. Their job is to sell you their bank's mortgage. Their loyalty is to the bank. Now, imagine instead of going to the dealership, you hire a professional car buying expert. This expert doesn't work for any single brand. They sit down with you and ask, what do you need? What's your budget? Do you need a truck for work? An SUV for the family? A fuel-efficient sedan for commuting? Then they take your exact needs and send them out to every major dealership in a 50-mile radius. Ford, Toyota, Honda, Chevy, you name it. They say, I have a highly qualified buyer right here. What is the absolute best, rock-bottom price you can give them on a vehicle that meets these specs? Suddenly, the dealerships are competing against each other. They're in a bidding war. They start sharpening their pencils, cutting their margins, because they know they're up against 10 other hungry competitors. The expert then comes back to you, lays all the offers on the table and says, here are the top 3 deals in the entire market. This one has the lowest price, this one has a better warranty, and this one you can pick up tomorrow. Which one do you want? That expert is the independent mortgage broker. They work for you. Their loyalty is to you. Their entire business model is built on having access to not just one lender, but dozens, sometimes over 100 different lenders. These aren't just the big banks, you know. They are a hidden network of wholesale lenders, financial institutions that don't have fancy branches on every street corner or spend billions on Super Bowl ads. They don't have a retail division for the public to walk into. They operate lean, mean, and entirely behind the scenes with one purpose: to offer incredibly competitive rates and products exclusively through mortgage brokers. Think about that. There is an entire universe of lenders with potentially better rates and more flexible guidelines that you, as a consumer, are physically unable to access on your own. You cannot call them. You cannot apply on their website. They only work with licensed brokers. Why? Because brokers are their sales force. Instead of hiring thousands of loan officers and building thousands of branches, these wholesale lenders outsource all of that to the independent broker community. This saves them a fortune in overhead, and they pass a large chunk of those savings on in the form of better interest rates. This is the secret the big banks don't want you to know. They want you to believe there are only a handful of options out there. They want you to stay on their lot. But a broker blows the doors wide open. They can take your single loan application and instantly shop it with giants in the wholesale space like United Wholesale Mortgage, the largest mortgage lender in the nation for years running, who you can't even call, or Rocket Mortgage's Pro Channel or HomePoint, or dozens of others you've never heard of. And here's the most critical part, the question that's probably burning in your mind right now. This sounds great, but it must be expensive. How does the broker get paid? This is where the magic happens. In the vast majority of cases, you don't pay the broker a single dime out of your pocket. Their compensation is paid by the lender who wins your business. It's called lender-paid compensation. The wholesale lender who provides the loan pays the broker a small percentage of the loan amount for bringing them a fully vetted, ready-to-go client. It's a finder's fee. This is a game changer. It means the broker's interests are perfectly aligned with yours. They don't make more money by steering you to a higher interest rate. In fact, their entire reputation and future business depends on getting you the absolute lowest rate and best service possible. So you'll sing their praises and send your friends to them. Their goal isn't to sell you one product from one company. Their goal is to make you so happy with the deal they found you that you become a customer for life. Let's break down the tangible advantages. First, the rate. Because brokers create a hyper-competitive environment, they almost always find a lower interest rate than you could find by walking into a bank. Even a tiny 0.25% difference on a $400,000 loan can save you over $50,000 in interest over the life of the loan. $50,000. That is a new car. That is a college fund. That is a life-changing amount of money. Second, the options. What if you're self-employed and your income looks a little unusual on paper? A big retail bank might run your application through their rigid, automated system and spit out a rejection. They have one box, and if you don't fit in it, you're out of luck. A broker, on the other hand, knows which of their 50-plus lenders specialize in bank statement loans for entrepreneurs. What if your credit score is a little bruised? They know the lenders who are more forgiving. What if you need to close on the house in 15 days? They know which lenders are the fastest and most reliable. They are a human search engine for solutions, not just a gatekeeper for a single institution. They turn a no from one bank into a yes from another. Third, the service. When you work with a broker, you have one point of contact. One person. You have their cell phone number. You're not calling an 800 number and getting routed to a call center in another country, re-explaining your situation to a new person every single time. The broker is your quarterback for the entire process, from application to closing. They fight the battles with the underwriter for you. They coordinate with the title company and the real estate agents. It is a concierge white-glove level of service that the megabanks simply cannot replicate. They're dealing with millions of customers. You are just a number. To your local independent broker, you are their entire business. Now you might be thinking, is there a catch? The only catch is that not all brokers are created equal. Just like there are great doctors and mediocre doctors, there are rockstar brokers and there are lazy ones. The power of this strategy is entirely dependent on finding a great, experienced, independent broker who truly has a vast network of lenders and puts your interests first. Some people might have had a bad experience with someone who called themselves a broker, but was really just working for a smaller, less competitive lender. The key is to find a truly independent broker, someone who is not just a branch of a larger retail company in disguise. And knowing they exist, knowing they are the key to unlocking the best possible mortgage, is the first and most important step. You've just taken that step. You are now miles ahead of the average homebuyer who just walks into the bank they've had a checking account with since they were 16, unknowingly leaving tens of thousands of dollars on the table. So we've established the who. The champion you need in your corner isn't a bank employee. It's an independent mortgage broker. We've established the why. They create a bidding war for your loan, unlocking a hidden world of wholesale lenders to get you lower rates, more options, and better service, all at no direct cost to you. But that leads to the $10,000 question. How do you find one of these top-tier brokers? How do you separate the sharks from the saints? What are the specific critical questions you must ask them in the first 5 minutes of a phone call to know with absolute certainty if they are the real deal or just another salesperson in disguise? Because getting that part wrong can be just as costly as not using a broker at all. Identifying that elite professional is the next crucial piece of the puzzle. So you're sitting across from a mortgage broker. They've got a firm handshake, a confident smile, and a stack of business cards that could choke a horse. They're telling you about their low rates, their fast closings, their 5-star reviews. It all sounds great. But in the back of your mind, there's that nagging voice, that little seed of doubt. How do you actually know? How do you look past the polished sales pitch and see the real operator underneath? This is where you stop being a customer and you start being an employer. You are not asking for a favor. You are conducting the most important job interview of your life, for a role that will manage the single largest debt you will ever take on. The person you hire will either be your greatest asset or your most catastrophic liability. And to find out which one they are, you need to run them through a gauntlet. A series of questions designed not just to get information, but to reveal character, competence, and commitment. Forget asking, "How long have you been in business?" That's amateur hour. We're going deep. Here is question number 1, the single most powerful question you can ask. You look them dead in the eye and say, "Let's pretend for a moment you are me. You have my job, my income, my exact credit score, and my down payment. You're buying this exact house for your family. What loan product would you get for yourself, and walk me through step by step exactly why." Now, pay close attention to what happens next. A salesperson will immediately pivot back to their prepackaged pitch. They'll say something like, "Well, for someone in your bracket, our most popular option is the 30-year fixed." They're just reciting a script. They didn't listen. They're trying to fit you into a box. But a true advisor, an elite professional, their entire demeanor will change. They'll lean forward. They might even say, "Wow, that's a great question." They will start thinking out loud. They'll say, "Okay, so with your income stability, but also the fact you might get a promotion in 3 years, we should look at this. Your credit is excellent, so we can avoid this type of mortgage insurance. You mentioned wanting to pay it off early, so a 15-year is an option, but it would make you house poor. So let's model out the 30-year, but with a built-in prepayment strategy." You see the difference? The first person is selling a product. The second person is solving a problem. They are putting themselves in your shoes and building a custom strategy from the ground up. That's who you want in your corner. Question number 2. This is the stress test for communication. You ask, "What is your communication policy?" To be specific, let's say it's 7 p.m. on a Friday. We just got the call that our offer was accepted, but the seller wants a revised pre-approval letter with the exact offer amount on it within the hour, or they're moving on to the next buyer. What happens? Again, watch the reaction. The average broker will give you a corporate answer. "Well, our office hours are 9 to 5, but you can leave a message, and we'll get back to you first thing Monday morning." Wrong answer. In the world of real estate, that's a death sentence. Deals do not happen between 9 and 5, Monday through Friday. They happen at night. They happen on weekends. They happen on holidays. The pro you want to hire will look at you and say, "You text me. You call me. You have my cell number for a reason. My team and I are set up for this. I can get you that letter from my phone in 10 minutes wherever I am. You will not lose a house because you were waiting on me." That's not just a promise of good service. It's proof they understand the battlefield you're about to enter. They know that speed is everything, and they've built their business to match the brutal pace of the market. Now for question 3, the one that reveals how they handle a crisis. Tell me about the most difficult, complicated, absolute nightmare of a loan you've ever had to close. What went wrong and what specifically did you do to fix it? A weak loan officer will freeze. They don't want to talk about failure. They'll either say they've never had a problem, which is a giant lie, or they'll give you a vague, sanitized story where they were the hero from start to finish. That's not what you're looking for. You are not looking for perfection. You are looking for resilience. A great broker will light up. They'll have a war story ready. They'll tell you about the time an underwriter got reassigned mid-file, or a last-minute appraisal came in low, or a buyer's credit score suddenly dropped a week before closing. They'll get into the weeds, explaining the frantic phone calls they made, the escalations they had to push, the creative solutions they had to invent to drag that deal over the finish line. Why is this so important? Because something will go wrong with your loan. It's almost a guarantee. There will be a moment of panic. And in that moment, do you want someone who has never seen a fire before? Or do you want the veteran firefighter who has been through hell and back and knows exactly how to put out the flames? Let's move to question 4, the rate trap. This is how you expose someone who is just competing on price versus someone who is competing on value. You say, I was just shopping online and I found a lender offering a rate that's 0.25% lower than what you've quoted me. Can you match it? The salesperson, the commodity broker, will give a simple yes or no. Or worse, they'll get defensive. They'll start bad-mouthing the other lender. This is a huge red flag. The true advisor will see this as a coaching opportunity. They'll respond with, absolutely, I might be able to. But before we do that, can you send me the official loan estimate from that other lender? A rate is just one number. I want to look at the fees in section A and B. I want to check the points they're charging you to get that rate. I want to see if they've padded the title and escrow fees. Often, a lender will advertise a super low rate to lure you in, but they make it all back, and then some, with thousands of dollars in hidden junk fees. Let's put both offers side by side on a spreadsheet, and I'll show you the true cost of both loans. Then we can make a decision. That is the sound of a fiduciary. That is someone protecting your wallet, not just their commission. They're not afraid of the comparison because they're confident that their total package, their service, their expertise, and their transparent pricing provides more value. They're teaching you how to analyze a deal, not just selling you a number. Finally, question number 5. The team question. Besides you, who else will I be working with? Who is your processor? Who is your primary underwriting contact? What happens if you get sick or go on vacation for a week? This question reveals if you're hiring a lone wolf or the leader of a professional team. Real estate is a team sport. A single broker trying to do everything themselves, the application, the processing, the communication with underwriters, the coordination with the title company, is a recipe for disaster. Things will fall through the cracks. Simply too much for one person to handle effectively. The elite broker will be proud of their team. They'll say, that's a fantastic question. My lead processor is named Sarah. She has 15 years of experience and she's an absolute rock star. You'll be introduced to her as soon as we're under contract, and she'll be your day-to-day contact for documentation. I oversee the entire strategy, but she is the engine that keeps the file moving. If I'm ever out of pocket, my partner John is fully looped in on all my files. You will never be left in the dark. This response shows they have a system, process, redundancy. It demonstrates that you're not just hiring a person. You're hiring a well-oiled machine built for one purpose: to get your loan closed smoothly and on time. So there you have it. The 5-question gauntlet. The empathy test, the communication stress test, the crisis test, the rate trap, and the team test. Go into that meeting prepared with these questions, and I guarantee you will walk out with crystal clarity. You will know with near certainty whether you're sitting with a paper-pushing salesperson or a strategic financial advisor who will fight for you every step of the way. Once you've found that person, your guide, your champion, their first job is to help you navigate the complex landscape of lenders. Because now you have to decide where to actually get the money from. Are you better off going to a massive national bank like Chase or Bank of America? Or does a small local credit union hold the secret advantage? What about these new, flashy online-only lenders that promise to close your loan from an app on your phone? Each of these paths has deep-seated pros and cons, hidden traps, and unique opportunities. And choosing the right one is the next critical decision you have to make. So let's break down these paths, starting with the one you probably know best: the giant national bank. Think Chase, Bank of America, Wells Fargo. The household names. Walking into one of these is like walking into a massive department store. It's familiar, it feels safe, and they have a department for everything: checking, savings, credit cards, and yes, mortgages. The biggest advantage here is the power of an existing relationship. If you've been banking with them for a decade, have your paychecks direct deposited, and maintain a healthy balance, you might get access to relationship-based discounts on your interest rate or closing costs. They want to keep your business, all of it, under their massive roof. The process can feel streamlined because they already have all your financial information. It's the path of least resistance, or so it seems. But here's the hidden trap of the department store model. The person who helps you in the mortgage aisle might just be a general bank employee, not a dedicated mortgage expert. They can answer basic questions, but when your situation gets even slightly complicated, you're self-employed, you have a recent gap in employment, you're buying a multi-unit property, their script runs out. You are then handed off to a faceless, centralized processing center, maybe hundreds of miles away. Suddenly, that personal touch is gone. You become a number in a queue. These massive institutions are built on rigid, standardized underwriting guidelines. If your financial picture doesn't fit perfectly into their pre-approved boxes, you can expect delays, frustration, and a potential denial that a more flexible lender would have approved. Their sheer size creates bureaucracy. A simple request can get lost in a corporate maze of emails and voicemails. So, who is the big bank really for? It's for the borrower with a rock-solid W-2 job, a fantastic credit score, a standard 20% down payment, and a desire to keep all their finances under one familiar umbrella. If you are the textbook definition of a vanilla borrower, they can be a stable, predictable choice. Now, let's leave the giant department store and walk down the street to the local boutique. This is your community bank, or even better, your local credit union. The difference in atmosphere is immediate. Here, you're not a number, you're a neighbor. Credit unions, in particular, are nonprofit institutions owned by their members. Their goal isn't to maximize shareholder profit, it's to serve their members. This fundamental difference in structure often translates into lower interest rates and fewer junk fees. The real superpower of these local institutions, however, is flexibility. Many of them are portfolio lenders, which is a game-changing term you need to know. It means they don't immediately sell your loan on the secondary market to Fannie Mae or Freddie Mac. They keep it in-house, on their own books. Because they're keeping the loan, they get to make their own rules. They can use common sense in their underwriting. Let's say you're a freelance graphic designer with fluctuating income, but a massive pile of cash in the bank and a perfect payment history. A big bank's automated system might red flag you instantly, but at a local credit union, you can sit down with a loan officer, a real person who lives in your town, and explain your story. They can look at the whole picture, not just the numbers on a form, and make a judgment call. This is invaluable for anyone with a non-traditional financial profile. The downside? Their technology might feel a decade old. Their app might be clunky, and their product selection might be limited. They may not offer certain government-backed loans, or have the capacity for a multi-million-dollar jumbo loan. But if you value personal service and have a story to tell with your finances, the local credit union isn't just an option. It might be your only path to approval. Next, we have the mortgage broker. The mortgage broker is not a lender. This is the most critical distinction to understand. A broker is your personal shopper, your expert guide through the chaotic mortgage marketplace. Think of it this way. A big bank can only sell you a big bank's mortgage. A credit union can only offer you a credit union's mortgage. A mortgage broker, on the other hand, has access to dozens, sometimes hundreds of different wholesale lenders. These are lenders you've never heard of, who don't advertise to the public and don't have brick-and-mortar branches. Their entire business model is to compete for the loans that brokers bring them, which forces them to be hyper-competitive on rates and fees. You go to a broker, you fill out one application, they pull your credit once, and then they do the shopping for you. They'll take your specific financial profile, your credit score, your income, your property type, and match it with the lender in their network who is most likely to offer the best terms and the smoothest approval. A great broker knows the intricate underwriting niches of each lender. They know that lender A is fantastic for self-employed borrowers, lender B is the best for VA loans, and lender C has a special program for people with lower credit scores. This is their entire job. They save you the immense hassle of applying at 10 different places, and can often find you a rate that's significantly lower than what you could find on your own. So what's the catch? The quality of your experience depends almost entirely on the quality of your individual broker. A bad broker can be a nightmare. Also, they do get paid for their service, either through a fee paid by you at closing or, more commonly, through a commission paid by the wholesale lender. While this is heavily regulated, it's a factor to be aware of. The broker is for the savvy consumer who wants to ensure they are getting the absolute best deal possible, and for anyone with a complex financial situation who needs an expert to navigate the system on their behalf. Finally, we arrive at the newest and shiniest option: the online direct-to-consumer lender. These are the tech companies of the mortgage world, like Rocket Mortgage or Better.com. Their entire value proposition is built on two things: speed and convenience. They have poured hundreds of millions of dollars into creating slick, user-friendly websites and mobile apps that allow you to apply for a mortgage in your pajamas at 2 in the morning. The process is heavily automated. You link your bank accounts, you upload your pay stubs, and an algorithm does much of the initial work. Because they've replaced expensive loan officers and fancy branch offices with software, their overhead is lower, which can sometimes translate into very competitive rates and low origination fees. For a straightforward borrower who is comfortable with technology, the appeal is undeniable. You can get a pre-approval letter in minutes, not days. The promise is a fast, frictionless, and cheap mortgage. But this digital assembly line has a dark side. The moment something goes wrong, the moment your file requires human intervention and critical thinking, the system can break down. You're often not dealing with a single dedicated loan officer. Instead, you're interacting with a call center. You might speak to Sarah on Monday, David on Tuesday, and a chatbot on Wednesday, none of whom have a deep, holistic understanding of your file. If the automated underwriting system flags an issue, a weird deposit, a complex bonus structure, an appraisal problem, getting it resolved can feel like screaming into the void. These companies are built for scale, processing thousands of simple cookie-cutter loans. They are not built for nuance. They are fantastic when everything goes perfectly. They can be an absolute catastrophe when it doesn't. The online lender is for the tech-savvy, self-directed borrower with an uncomplicated financial life who prioritizes speed and a low sticker price above all else, and who is willing to trade personal service for digital efficiency. So you have 4 distinct paths. The big bank, a fortress of stability for the perfect borrower. The local credit union, a haven of flexibility and personal touch. The mortgage broker, an expert guide for the savvy shopper. And the online lender, a high-speed digital tool for the modern consumer. None is universally best. The best choice depends entirely on who you are. It depends on your finances, your personality, and your tolerance for risk. Choosing your path is the first half of the battle. The second half is understanding the offers they put in front of you. Because a great lender can still give you a bad deal if you don't know what to look for. And the place where they hide all the details, the good, the bad, and the ugly, is on a 3-page document called the loan estimate. This is it. This is the Rosetta Stone of mortgages. You get this form within 3 business days of applying with any lender. And I mean any lender. It's a standardized government form, which is the best thing that ever happened to consumers. It means you can take a loan estimate from a big bank, a credit union, and an online lender, and compare them apples to apples, line by line. Understanding this document is your superpower. It's the difference between walking into closing confident and walking in with a pit in your stomach, praying there are no surprises. So let's break it down. Page 1 is the big picture summary. It's designed to give you the most critical information at a glance. Right at the top, you'll see the loan term, the purpose, the product, like a 30-year fixed, and critically, the loan type. Make sure this says conventional, FHA, VA, whatever you discussed. If it's wrong here, everything that follows is meaningless. Next, you see a simple but vital question. Is your interest rate locked? If this box says no, then the interest rate you see is just a pretty number on a piece of paper. It's a guess. It can change tomorrow or in an hour. If it says yes, you'll see a lock-through date. This means the lender is guaranteeing you that rate as long as you close by that date. Getting a rate lock is a major milestone, but don't rush it. We'll talk about the strategy behind when to lock your rate in a later part. Now for the first of the 3 magic numbers on page 1. The loan amount and interest rate. This is the number everyone obsesses over, and for good reason. 0.25% might not sound like much, but on a $400,000 loan, it can mean tens of thousands of dollars over 30 years. Below that is the second magic number, the projected monthly payment. This is broken down into principal and interest, which is the core part of your loan payment, and then the estimated escrow. What's escrow? Think of it as a forced savings account managed by your lender. Every month, you pay a little extra, and they put that money aside to pay your property taxes and your homeowner's insurance on your behalf when they come due. This number is just an estimate, because taxes and insurance can change, but it's crucial for budgeting. The total of these two is your estimated total monthly payment. This is your all-in monthly housing cost, minus things like utilities or HOA fees. This is the number you need to be brutally honest with yourself about. Can you comfortably afford this every single month, even if life throws you a curveball? Finally, at the bottom of page 1, you get the third magic number: estimated cash to close. This is the amount of money you need to bring to the closing table. It's not just your down payment. It includes your down payment plus all your closing costs, minus any credits you might be getting from the lender or the seller. This is the big one. This is the number that sends people scrambling for their checkbooks. It's also just an estimate at this stage, but if this number on the loan estimate from lender A is wildly different from lender B, you need to find out why. That's page 1. The snapshot. But the devil, as they say, is in the details, and the details live on page 2. This is where you can get fleeced if you're not paying attention. Page 2 is called Closing Cost Details, and it's broken down into 2 main columns: loan costs and other costs. Let's focus on the loan costs first, specifically section A, origination charges. This is what the lender is charging you to create the loan. It's their profit. You'll see things like an underwriting fee, a processing fee, or an application fee. But the most important line item here is points. This is one of the most misunderstood concepts in mortgages. Points are a fee you pay up front to get a lower interest rate. 1 point equals 1% of the loan amount. So, on a $300,000 loan, 1 point costs you $3,000. Lenders might offer you a rate of 6.5% with 0 points, or a rate of 6.25% for 1 point. You're essentially prepaying interest to get a lower monthly payment. Is it worth it? It's a math problem. You have to calculate your break-even point. If paying $3,000 saves you $50 a month, it will take you 60 months or 5 years just to break even. If you plan on being in the house for 15 years, it's a great deal. If you think you might move or refinance in 3 years, you just threw that money away. When you're comparing lenders, make sure you're comparing offers with the same number of points. A lender offering a super low rate might be charging you 2 or 3 points to get it, making their offer much more expensive upfront. Now look at section B, services you cannot shop for. This is a critical section. These are fees for services required by the lender, and they get to pick the company. Think of it like this. If you take your car to a specific dealership for a warranty repair, they tell you which parts they're using. You don't get to bring your own. That's what's happening here. This includes things like the appraisal fee, the credit report fee, and the flood determination fee. Because you can't shop for these, the lender is legally held to these figures. The final cost for these services at closing can't be more than 10% higher than what's quoted here, unless there's a valid change of circumstance. This is a key protection for you. Next is section C, services you can shop for. This is your chance to save some serious money. This is the lender saying, you need these services, but we don't care who you use. This list includes some of the most expensive third-party costs, like the title search, the title insurance binder, and the settlement agent fee. The lender will give you a list of their preferred providers, but you are absolutely not required to use them. You can and you should shop around. Call 3 or 4 different title companies or settlement agents in your area. Get quotes. You could easily save $500, $1,000, or even more dollars just by making a few phone calls. It's like getting quotes from different mechanics for a car repair. Why would you just accept the first price you're given? Most people just go with the lender's recommendation out of convenience, leaving a pile of money on the table. Don't be most people. The rest of page 2 lists other costs like taxes, government recording fees, and prepaid items like your first year of homeowner's insurance. These costs are going to be roughly the same no matter which lender you choose, because they are set by your local government or the insurance company you select. Finally, we flip to page 3. This page is all about comparison and long-term perspective. At the top, you'll find the comparisons table. This tells you how much you'll have paid in 5 years, and how much of that went to actually paying down your loan principal. It's a sobering look at how front-loaded interest is on a mortgage. Then you see 2 very important acronyms, APR and TIP. The APR, or annual percentage rate, is often confused with the interest rate. They are not the same. The interest rate is the cost of borrowing the money. The APR is the cost of borrowing the money plus most of the fees the lender is charging you, expressed as an interest rate. Think of it as a more honest rate. If lender A offers a 6.5% interest rate with $5,000 in fees, and lender B offers a 6.6% interest rate with only $1,000 in fees, lender B might actually have a lower APR. The APR is supposed to make it easier to compare the true cost of loans. It's a useful tool but not a perfect one because it doesn't include all fees. Always look at the APR, but don't let it be the only thing you look at. The last big number is TIP, which stands for total interest percentage. This tells you how much interest you will pay over the entire life of the loan, expressed as a percentage of your loan amount. For a 30-year loan, this number is often over 100%. Yes, you read that right. You will likely pay more in interest than the original amount you borrowed. It's a shocking, terrifying number, and it's meant to be. It's a stark reminder of the long-term cost of borrowing a massive amount of money. By mastering these 3 pages, you've taken control. You're no longer just a passive applicant hoping for a good deal. You are now an informed consumer who can spot junk fees, compare offers intelligently, and ask sharp, specific questions. You can confidently look at 2 loan estimates and say, okay, this one has a lower rate but higher origination fees and a much higher APR. The other one has a slightly higher payment, but I'm paying $2,000 less in upfront costs. You've cracked the code, but knowing how to read the menu is one thing. Getting the chef to give you the best dish at the best price is another. Now that you can read a loan estimate like a pro, how do you get lenders to compete against each other and give you their absolute best offer? How do you leverage one offer to get a better one from someone else? That's because getting the best deal isn't just about finding the best restaurant. It's about making the chefs compete to cook for you. This is the part of the process where the power shifts entirely into your hands. This is where you can save not just hundreds but thousands, or even tens of thousands of dollars over the life of your loan. And it all starts with a simple, powerful concept: making lenders fight for your business. First, let's get one thing straight. This is not about being rude, aggressive, or trying to cheat the system. This is business. Lenders are in the business of lending money, and your mortgage is a highly valuable product to them. You are a prized customer. They expect you to shop around. The ones who get flustered or refuse to negotiate are often the ones you don't want to work with anyway. The best loan officers are confident in the value they provide and are prepared to have a professional conversation about their pricing. So, how do you orchestrate this competition? The first step is to gather your ammunition. You need to apply with at least 3 to 5 different lenders, all on the same day. Why the same day? Because mortgage rates can change daily, even hourly. If you get one loan estimate on a Monday and another on a Wednesday, you're not comparing apples to apples. You're comparing an apple from Monday to an orange from Wednesday. The underlying market conditions have changed, making a true comparison impossible. Applying on the same day ensures that all the lenders are pricing their loans based on the exact same market data. This is your level playing field. Once you have those 3, 4, or 5 loan estimates in hand, print them out. Lay them side by side on your kitchen table. Now, you're the general looking at the battlefield. Using what we learned in the last part, your eyes should immediately go to 2 key areas. Page 2, Section A, the origination charges, and Page 1, the interest rate. Let's say you have 3 offers. Lender A has a 6.5% rate with $2,000 in origination fees. Lender B has a 6.375% rate, but with $4,000 in origination fees. And Lender C has a 6.5% rate, but with only $1,000 in origination fees. Right away, you can see Lender C has the most attractive offer based on fees, tying with Lender A on the rate. Lender B has the lowest rate, but their fees are double the next highest. This is your starting point. Your goal is to get the best of all worlds. Lender B's rate with Lender C's fees. It might not be entirely possible, but if you don't ask, the answer is always no. Now you pick up the phone. Or if you prefer a paper trail, you draft an email. Let's start with Lender A. You're going to call the loan officer and be polite, professional, and direct. Sounds something like this. Hi, a loan officer's name. It's your name. Thanks again for sending over the loan estimate. I've had a chance to review it alongside a couple of other offers I received today. I really appreciate your help so far and I'd prefer to work with you. However, I have another official loan estimate right here in my hand from Lender C offering the exact same 6.5% rate, but their total origination charges in Section A are only $1,000, which is a full $1,000 less than your offer. I also have an offer from Lender B at 6.375%. To be honest, if you can match the $1,000 origination fee from Lender C, you'd be my top choice and we could move forward today. Let's break down why this works. 1. You're being honest. You have the offers in hand. Never, ever lie or invent a competing offer. They might ask you to prove it by sending them the competitor's loan estimate, And if you can't, you've lost all credibility. 2. You complimented them. "I'd prefer to work with you" is a powerful phrase. It makes them want to find a way to win. 3. You were specific. You didn't just say, "Can you do better?" You gave them a concrete target. $1,000 in origination fees. This turns a vague negotiation into a simple math problem for them. 4. You created a sense of urgency and ease. "We could move forward today." Tells them they are one simple decision away from closing a deal. Now, you do the same thing with lender B, the one with the low rate but high fees. The script is slightly different. "Hi, a loan officer's name. It's your name. Thanks for the loan estimate with the 6.375% rate. I'm really impressed with that rate. As I'm comparing offers today, I see that your origination charges in Section A are about $3,000 higher than an offer I received from lender C. I understand that a lower rate often comes with higher costs, but I'd like to give you the opportunity to win my business. If you could significantly reduce those origination fees to be more competitive with my other offers, I'd be ready to proceed. What's the absolute best you can do on the fees while keeping that rate?" Notice the subtle shift. You're acknowledging their strength, the rate, while pointing out their weakness, the fees. You're not giving them a hard number to match, but instead asking them, "What's the best you can do?" This invites them to sharpen their pencil and show you their best hand. After you've made these calls or sent these emails, you wait. One of 3 things will happen. The lender will say no, they can't change their pricing. This is rare, but if it happens, you thank them for their time and move on. Or they'll say yes, they can match it. Or they'll meet you somewhere in the middle. Let's say lender A agrees to match the $1,000 fee. Fantastic. You now have an offer for 6.5% with $1,000 in fees. And let's say lender B comes back and says they can't get their fees down to $1,000, but they can cut them in half to $2,000. So now you have a new offer from lender B. 6.375% with $2,000 in fees. This is a critical rule. Get every new offer in writing. A verbal promise on the phone is not a mortgage offer. Tell them, "That sounds great. Can you please send me an updated, official loan estimate reflecting that new pricing?" This is non-negotiable. Until you have it in writing, it doesn't exist. Now you have 2 improved offers. You're comparing 6.5% with $1,000 in fees versus 6.375% with $2,000 in fees. The second option has a lower rate, but costs you an extra $1,000 upfront. This is where you have to decide what's more important: a lower monthly payment or less cash out of pocket at closing. We'll dive deeper into that math in a later part, but for now, let's assume the lower rate is more attractive to you. You're not done yet. It's time for the final round. You don't want to keep going back and forth with all 5 lenders. That's exhausting and can burn bridges. You pick your top 2. In this case, it's the newly revised offer from lender B, and your original favorite, lender C, who had the low fees from the start. You can now go back to lender C, the one you haven't negotiated with yet, and play your strongest card. The call goes like this: "Hi, a loan officer's name at lender C. It's your name again. I've finished my review of all the offers, and I wanted to give you a final opportunity. Your initial offer of 6.5% with $1,000 in fees is very strong. However, I've just received a revised written offer from another lender for 6.375% with $2,000 in fees. Honestly, I've been most impressed with your responsiveness and service so far. And all things being equal, you're who I want to work with. Is there any way you can match the 6.375% rate? Even if you can't get the fees all the way down to your original $1,000, if you can get close on the rate, the business is yours." This is the master stroke. You've made it clear they are your preferred choice. You've presented them with a real, legitimate, and better offer. And you've given them a clear target to hit. You're telling them exactly what they need to do to win. The loan officer at lender C now has a decision to make. They might have to talk to their manager. They might have to give up some of their commission. But if they want your loan, they will often find a way. They might come back and say, "Okay, we can do the 6.375% rate, but our fees will have to be $1,500. And there it is. The winning offer. You've just negotiated a deal that is better than any of the initial offers you received. You got the lowest interest rate from the market, and you got it with fees that are significantly lower than what was originally offered with that rate. You did this not by being a jerk, but by being prepared, professional, and strategic. You gathered the data, you created a competitive environment, and you clearly communicated your position. You saved yourself thousands of dollars with a few 10-minute phone calls. This process is the single most important thing you can do to ensure you get the best mortgage. Never ever take the first offer you receive. The lending industry is built on the assumption that many people won't bother to shop around. By simply getting 3 quotes and making a few phone calls, you are putting yourself in the top tier of savvy homebuyers. So now you've done it. You've negotiated a killer deal. You have a low rate and low fees, confirmed in writing on an official loan estimate. But that rate isn't truly yours yet. It's floating in the wind, subject to the daily whims of the global bond market. A bad inflation report tomorrow could cause your 6.375% to jump to 6.625% overnight, wiping out all your hard work. How do you capture it? How do you officially lock it in and protect yourself from that risk? And more importantly, what are the hidden traps of rate locks that can cost you thousands if you're not careful? That's what we're breaking down next. Think of an interest rate as a wild, untamed beast. It roams freely in the financial markets, its mood changing from one moment to the next based on news headlines, economic reports, and global events. One day it's calm and low, the next it's angry and soaring. When you find a rate you like, you can't just admire it from afar. You have to capture it. You have to put it in a cage. That cage is called a rate lock. A rate lock is a legally binding promise from your lender to give you a specific interest rate for a specific period of time on a specific property. It's you telling the bank, I want that rate right there. Freeze it. And the bank agrees, okay, you've got it. But the clock is now ticking. This ticking clock is the most important part of the deal. Rate locks aren't forever. They have an expiration date. The most common lock periods are 30, 45, or 60 days. The lender is essentially betting that they can get your entire loan file, from application to appraisal to final approval, completely finished and funded before that clock hits 0. Now you might be thinking, great, I'll just ask for the longest lock possible. Give me 90 days. Not so fast. There's no free lunch in the mortgage world. The longer the lock period, the more risk the bank is taking on. What if rates shoot up during those 90 days? They're still stuck giving you the lower rate they promised. To compensate for that risk, lenders charge you for it. A 60-day lock will almost always have a slightly higher interest rate or higher closing costs than a 30-day lock. It's a trade-off between safety and cost. The sweet spot is choosing a lock period that is realistic for your situation, without being excessively long. Your loan officer should be able to give you a very clear estimate of how long it will take them to close your loan. If they're pushing a 30-day lock but you haven't even had the home inspection yet, that's a major red flag. This is where we uncover the first and most common trap: the expiring lock. Life happens. Appraisals get delayed. Underwriters ask for one more document. The seller needs an extra week to move out. Suddenly, you're on day 43 of your 45-day lock and you're starting to sweat. If that lock expires before your loan closes, the deal is off. The cage door swings open, and that rate you captured is gone forever. You are now completely exposed to whatever the rates are on that day. If rates have gone up by 0.5%, which can easily happen in a volatile month, your monthly payment just permanently increased by hundreds of dollars. The home you could afford a month ago might now be out of reach. It's a catastrophic failure point in the process. This leads directly to the second hidden trap: the extension ransom. Lenders know you're in a terrible position if your lock is about to expire. So they offer you a solution, a lock extension. But it comes at a steep price. They'll say, sure, we can extend your lock for another 7 or 15 days, but it's going to cost you. This fee is often calculated as a percentage of the loan amount and can easily run you $500, $1,000, or even several $1,000s paid up front right out of your pocket. Feels like a ransom payment because that's exactly what it is. You either pay up or your beautiful low interest rate gets it. The worst part? The delay might not even be your fault, but you're the one who has to pay the price. But what about the opposite scenario? This is the third and perhaps most frustrating trap: the float-down illusion. Let's say you lock your rate at 6.5%. You're happy. A week later, there's great news about the economy, and rates suddenly tumble down to 6%. You call your loan officer excited. Hey, can I get that new lower rate? And you're met with a soul-crushing silence. Because you're locked. The cage works both ways. It keeps the rate from going up, but it also keeps it from coming down. Now, some lenders offer something called a float-down option. This sounds like the perfect solution, right? A safety net. If rates go down, you get the lower rate. If they go up, you're protected. But it's an illusion because it's rarely that simple or free. First, many lenders charge a hefty fee for this option, sometimes up to 0.5% of your loan amount. Second, there are usually very strict rules. For example, the rate might have to drop by a significant amount like 1/4 or 0.5% before you can even use the option. A tiny drop won't count. And third, you usually only get to exercise the option once. If you use it and rates drop even further, you're out of luck. Many borrowers pay for a float-down option they never get to use, or they find the rules are so restrictive it's basically worthless. It's often just a marketing gimmick designed to make you feel safe while they collect another fee. This brings us to the fourth and most sinister trap, the deliberate bait and switch. This is where an unscrupulous lender knows exactly what they're doing. They'll quote you an unbelievably fantastic rate, a rate that's way better than any of their competitors. But here's the catch. They'll tie it to an unrealistically short lock period, like 21 or even 15 days. They know, and you don't, that there is virtually no chance your loan will close that quickly. They are banking on the fact that once you're deep into the process, with your appraisal paid for and your heart set on the house, you'll be trapped. When the short lock expires, they'll hit you with the extension fees we talked about, or worse, they'll say, "Sorry, that rate is gone. The best we can do now is this much higher rate." By the time all the fees and new rates are factored in, their unbelievably good deal is now far worse than the honest quotes you got from other lenders. You've been played. So how do you navigate this minefield and lock your rate like a pro? You do it by asking the right questions before you agree to anything. Before you commit, you need to look your loan officer in the eye, or on the Zoom call, and ask them these 4 critical questions. 1. What is your lock extension policy? Don't just ask if they have one. Ask for the specifics. How much does it cost? How is it calculated? And who is responsible for the fee if the delay is the lender's fault? Their answer will tell you everything you need to know about how they treat their clients when things go wrong. 2. What are the full terms and conditions of your float-down option? Is there a fee? What's the minimum drop required to trigger it? Is it a one-time use? If they're vague or can't give you a clear written policy, assume the option is worthless. 3. Based on my specific situation and current processing times, how confident are you that we can close within this lock period? Make them give you a real answer. An honest loan officer will say something like, based on our current turn times of 7 days for underwriting and 10 days for an appraisal, a 45-day lock gives us a comfortable buffer for any unexpected issues. A dishonest one will just say, "Oh yeah, no problem," without any justification. And finally, number 4, the most important rule of all, get it in writing. Never ever rely on a verbal promise for a rate lock. Demand a written rate lock agreement. This document should clearly state your name, the property address, the loan amount, the interest rate, any points you're paying, the lock-in date, and crucially, the lock expiration date. Read every single word of it. If it's not in that document, it doesn't exist. Locking your rate isn't just a formality. It's one of the most critical financial decisions you'll make in the entire home buying process. It's the moment you transition from a casual shopper to a committed buyer with real money on the line. But once that lock is in place, a new, even more mysterious process begins. Your loan file is packaged up and sent to a hidden department, a place where most borrowers are never allowed to look. It's sent to the underwriters. These are the ultimate gatekeepers, the faceless decision-makers who hold your financial future in their hands. They will scrutinize every single piece of paper, every bank statement, every job title you've ever had, looking for one reason, any reason to say no. What exactly are they looking for in this underwriting black box? And what are the surprising last-minute deal killers that can blow up your mortgage, even after you have a written lock agreement? That's where we're going next. So let's pull back the curtain on that underwriting black box. It's not some mystical chamber where a loan officer rolls dice on your future. It's a methodical, forensic-level investigation into your financial life, conducted by a person called an underwriter. And their job, their only job, is to protect the lender's money. They are the final gatekeeper, and they are trained to find reasons to say no. Their entire purpose is to answer one fundamental question. If we lend this person hundreds of thousands of dollars, what is the statistical probability that they will pay it back on time every single time for the next 30 years? To answer that, they operate on a framework often called the 3 Cs: capacity, credit, and collateral. First, capacity. This is the big one. It's not just about your income. It's about the stability and predictability of your income. Do you have the capacity to repay the loan? They'll start with your debt-to-income ratio, or DTI, which we touched on earlier. But they go so much deeper. If you're a W-2 employee who's been at the same job for 5 years with a steady salary, that's a green light. It's simple, it's clean, it's predictable. But what if you just got a huge raise? They'll want to see proof, usually a pay stub or two, to verify it's real. What if a huge chunk of your income is from bonuses or commissions? Now it gets tricky. They won't just take your word that you're getting a big bonus this year. They'll need a 2-year history. They'll average out your bonuses and commissions over the last 24 months to create a more conservative, predictable income figure. If you just started a sales job 6 months ago and are crushing it, that's great for you, but to an underwriter, that's an unproven volatile income stream. They see risk. And for the self-employed, this is where the real interrogation begins. They will want 2 years of tax returns, personal and business. They will scrutinize your profit and loss statements. They will look at your bank statements to verify cash flow. And here's the kicker. They underwrite your loan based on your net income after write-offs, not your gross revenue. So all those business expenses you cleverly wrote off to lower your tax bill, you just lowered the income the bank will use to qualify you for a loan. It's a classic catch-22 for entrepreneurs. The second C is credit. The underwriter isn't just looking at your FICO score. That score is just the headline. They are reading the entire story of your financial behavior. They're looking at your payment history. A single 30-day late payment on a credit card 2 years ago might be fine. A 60-day late payment on a car loan 6 months ago is a massive red flag. It shows recent financial distress. They're looking at your credit utilization. Are all your credit cards maxed out? That signals you're living on the financial edge. They're looking for collections, judgments, and bankruptcies. A small, forgotten medical collection from 3 years ago can absolutely derail your loan until it's paid off, and you have a letter to prove it. They are looking for patterns of responsibility. The third C is collateral. This is the house itself. Is the property you're buying actually worth the amount of money you're borrowing? This is determined by the appraisal. The lender will hire an independent, licensed appraiser to inspect the home and compare it to recently sold, similar properties in the same neighborhood. This is called running comps. The appraiser provides a detailed report with their professional opinion of the property's fair market value. If you agreed to pay $400,000 for a house, and the appraisal comes back at $400,000 or more, you're golden. But if that appraisal comes in at $380,000, you have an appraisal gap. The bank will only lend you money based on the appraised value, the $380,000. That $20,000 difference? It has to come from somewhere. Either you pay it out of pocket, the seller has to agree to lower the price, or some combination of the two. If no one can agree, the deal often falls apart. The collateral must support the loan. Now let's say you've passed all 3 Cs. Your income is stable, your credit is clean, the appraisal is solid. You get the letter you've been waiting for. Congratulations, you are conditionally approved. You have a rate lock. You think you're in the clear. This is the most dangerous moment in the entire process. This is the period where most buyers make a catastrophic mistake. Because you are not done. You are under a microscope until the moment you sign the final papers. So let's talk about the surprising last-minute deal killers that can blow up your mortgage. Number 1, do not change jobs. I don't care if it's for a $50,000 raise in a corner office. Quitting your job, or even changing employers in the middle of the underwriting process, is a giant red flag. It changes the entire foundation of the approval. The underwriter has to re-verify everything. If you move from a salary to a commission-based role, it could kill the deal instantly. Even if it's a better job, the lack of history in that new role introduces risk. The rule is simple. Wait until after you have the keys to the house in your hand before you give your 2 weeks' notice. Number 2, do not make any large, undocumented cash deposits into your bank account. If your grandma gives you $10,000 in cash for your down payment, you can't just deposit it. That's a huge problem. Underwriters need to source and season all funds. Seasoned means the money has been in your account for a certain period, usually 60 days. An unseasoned large deposit raises questions about where the money came from. Is it a loan you didn't disclose? Is it from an illegal source? Any money for your down payment needs a clear paper trail. If it's a gift, it requires a formal gift letter from the donor stating it's not a loan. Number 3, and this is the most common mistake, do not open any new lines of credit. Period. Don't go buy new furniture for the house on a store credit card. Don't decide it's the perfect time to lease a new car because you'll have a garage to put it in. And for the love of all that is holy, do not co-sign a loan for anyone, not even your favorite cousin. The second you open a new line of credit, 2 things happen. First, the hard inquiry dings your credit score. Second, and more importantly, that new monthly payment gets added to your debts, which immediately changes your DTI ratio. I have seen deals fall apart days before closing because a buyer financed a $2,000 sectional sofa, and that extra $80 monthly payment was just enough to push their DTI over the lender's maximum limit. Loan denied. Number 4. Don't move money around. Don't consolidate your accounts or transfer large sums between your checking and savings. Underwriters need to see a clear, stable picture. When you start moving thousands of dollars around, it creates a confusing paper trail that they have to investigate and document, causing delays and raising suspicion. Pick the accounts you're going to use for the transaction and leave them alone. And finally, a few things that should be obvious but happen all the time. Don't miss a payment on any of your existing bills. Don't be late on your current rent, your car loan, or your credit cards. Lenders often do a soft pull of your credit again right before closing to see if anything has changed. A new late payment is a deal killer. And don't forget, the lender will call your employer, sometimes on the very day of closing, for a final verbal verification of employment. They want to confirm that yes, you are still employed there right now. Navigating this final stretch is like walking through a minefield. You have to be disciplined. Your financial life needs to be completely frozen from the moment you apply until the moment you close. You've survived the underwriter's investigation. You've avoided all the last-minute traps that sink so many other buyers. So what happens now? What exactly are you signing in that 1-inch thick stack of documents at the closing table? And what are the hidden junk fees you need to watch out for that can cost you thousands? That's the final hurdle between you and your new home. So let's walk into that closing room together. You'll sit down at a long, polished conference table. Across from you is a closing agent, or maybe an attorney with a smile that's a little too practiced. And in front of them is the beast. A stack of paper so thick it looks like the manuscript for a novel. Your novel. The one where you take on hundreds of thousands of dollars in debt. They'll slide it over to you, along with a pen, and say something like, "Okay, just a few signatures and we'll be all done." A few signatures. That's the biggest understatement in the financial world. You'll be initialing and signing so many times your hand will cramp. This is the moment of truth. This is where a lack of preparation can cost you dearly. The pressure is immense. The seller wants their money. The agents want their commission. You just want the keys. It's a psychological trap designed to make you sign quickly without reading. But you're not going to do that, because you understand that this stack of paper isn't just a formality. It's a series of legally binding contracts that will dictate a huge part of your financial life for the next 30 years. But here's the secret. You don't need to read every single word of that 1-inch stack. You just need to know which 3 documents are the main characters in this story, and how to spot the villains, the junk fees hiding in the credits. First, the most important document of them all. It's called the closing disclosure, or the CD. Think of this as the final official report card for your loan. By law, your lender must give you this document at least 3 business days before you are scheduled to close. This 3-day rule is your superpower. It's your legal right to have time to review everything without pressure. If a lender tries to rush you or says you'll just get it at the closing table, that is a colossal red flag. Do not proceed. When you get that closing disclosure, you're not just going to glance at it. You're going to pull out the very first document you received in this whole process, your loan estimate. You're going to put them side by side. This is your final exam, and the loan estimate is your cheat sheet. The numbers on the closing disclosure should look almost identical to the numbers on your loan estimate. Your loan amount, your interest rate, your monthly payment, these should not have changed unless you specifically requested a change and agreed to it in writing. Pay special attention to the closing costs section. Some fees, like the appraisal fee or credit report fee, can change slightly, but there are certain lender fees that, by law, cannot increase at all from the loan estimate to the closing disclosure. If you see new, unexpected fees or significant increases, you pick up the phone immediately and call your loan officer. You don't ask what happened. You state, "The fee for X on my closing disclosure does not match my loan estimate. Please correct this." This 3-day window is your time to fight, to question, and to get things fixed. Don't wait until you're at the table. The second hero document in that stack is the promissory note. This one is simple, but it's the most powerful. This is your IOU. This is the document where you, the borrower, make the formal promise to repay the loan. It will clearly state the total amount of money you're borrowing, the interest rate you'll pay, the dates your payments are due, and where you need to send the money. It also spells out the penalties if you pay late. Read it. It's usually only a page or 2. This is the core of your debt. Understand your promise. The third and final major document is either the deed of trust or a mortgage, depending on your state. They function in basically the same way. If the promissory note is your promise to pay, the deed of trust is the or else. This is the document that secures the loan with the property itself. It's what gives the lender the right to foreclose and take the house if you fail to uphold the promise you made in the promissory note. It's the bank's insurance policy. You need to know it exists and what its purpose is. It's the teeth behind the loan. Okay, so you've checked your closing disclosure against your loan estimate. You understand the promissory note and the deed of trust. Now we hunt for the villains. We go after the junk fees. These are the annoying, often vaguely named charges that lenders or title companies slip into your closing costs to pad their profits. They can add up to hundreds, even thousands of dollars. They're counting on you being too overwhelmed to notice. Let's name and shame the most common ones. First up, processing fee or administration fee. This is often bogus. You're already paying an origination fee, which is the lender's main charge for creating the loan. An extra processing fee is like a restaurant charging you an eating fee after you've already paid for the meal. Question it. Ask, what specific service is this fee for that isn't already covered by the origination fee? Often they'll squirm and might even waive it. Next on the hit list, underwriting fee. Again, underwriting is the core job of the lender. It's the process of them evaluating your risk. Charging you a separate fee for this is like a car dealership charging you a salesman fee for the act of being sold a car. It should be part of their cost of doing business, wrapped into the origination fee. It is often negotiable. Watch out for the document preparation fee. They're charging you for printing out the very documents they require you to sign. In today's world of software and templates, this is almost pure profit. Some states cap this fee, but many don't. Always question it. Here's a classic, the courier fee. They might charge you $50 or even $100 to transport documents. In an age of email, secure digital portals, and FedEx, these fees are often wildly inflated or completely unnecessary. Ask for a specific breakdown of what was couriered and why it couldn't be handled digitally. Be wary of any fee with vague words like service or miscellaneous. If you see a lender service fee, your first question should be, what service? If they can't give you a straight, tangible answer, it's probably junk. The key is to not be aggressive but to be inquisitive and firm. When you see a fee you don't understand, you point to it and say, can you please explain this charge to me? What service was rendered for this exact amount? Don't let them give you a vague answer like, oh, that's just a standard closing cost. There is no such thing. Every line item is a charge for a specific service, and you have the right to know what it is. If you've done your homework and compared multiple loan estimates like we talked about in earlier parts, you'll already have a good sense of what's normal and what's an outlier. Finally, before you even sit at that table, you must do one last thing, the final walkthrough. Within 24 hours of closing, you need to walk through the property one last time. You are checking to make sure the home is in the same condition it was in when you agreed to buy it. You're making sure any agreed-upon repairs have been completed. You're testing the appliances, flushing the toilets, checking for any new damage. If the seller was supposed to leave the washer and dryer and they're gone, you do not close. If they were supposed to patch a hole in the wall and it's still there, you do not close. The closing table is your point of maximum leverage. Once you sign those papers and the money changes hands, getting the seller to fix anything becomes a nightmare. So you do the walkthrough, and you only proceed to closing if everything is as it should be. This whole process, from getting your 3-day disclosure to the final walkthrough to questioning fees at the table, is about shifting the balance of power. They want you to feel like a guest at their party, grateful to be invited. But you are not a guest. You are the customer. You are the one bringing hundreds of thousands of dollars to the table. You are in charge. So you've reviewed the documents. You've successfully challenged a few junk fees and saved yourself $1,000. The house is in perfect condition. You pick up the pen, your hand is steady, and you sign. A mountain of paper becomes a set of keys slid across the table. They're yours. You've done it. You own a home. The relief, the excitement, it's incredible. But the journey isn't over. Because now the real work begins. What happens a month from now when that first bill arrives? How does escrow actually work? And how do you make sure you're not overpaying on property taxes and insurance? And most importantly, what is the secret to paying this massive loan off years, or even decades ahead of schedule? That's the final piece of the puzzle. Let's start with that thing called escrow. Sounds complicated, but it's actually pretty simple. Think of it like a forced savings account that your lender manages for you. You see, the bank has a massive financial stake in your house. If the house burns down or gets seized by the government for unpaid taxes, their investment goes up in smoke. So they don't trust you to save up for those big and frequent bills on your own. Instead, they estimate your total annual property tax bill and your total annual homeowner's insurance premium. They add those two numbers together, divide by 12, and tack that amount onto your monthly mortgage payment. So when you see that acronym PITI, it stands for principal, interest, taxes, and insurance. The P and I go to the bank to pay down your loan. The T and the I go into your escrow account. Then, when those big bills come due, the bank pays them for you automatically, using the money you've been setting aside every month. Now, you might notice your lender collects a little extra. They're legally allowed to keep a cushion in your escrow account, usually about 2 months' worth of payments. This is to cover any unexpected increases in your taxes or insurance, so they don't have to front the money. Once a year, they'll do what's called an escrow analysis. They'll look at what they collected versus what they actually paid out. If they collected too much, congratulations, you get a check in the mail for the surplus. Feels like free money even though it was your money all along. But if your property taxes or insurance premiums went up, you'll have a shortage. This is the part that stings. Not only will your monthly payment increase for the next year to cover the new, higher costs, but you'll also have to make up for the shortfall. The bank will either ask for a lump sum payment or, more commonly, spread that shortage out over your next 12 payments, making your monthly bill jump even higher. So how do you stop this from spiraling? How do you make sure you're not overpaying? You have to be proactive. First, your property taxes. These are based on your home's assessed value, which is determined by your local government. But here's the thing, those assessments can be wrong. They might have the square footage wrong, the number of bathrooms wrong, or they might just be valuing your home higher than similar homes in your neighborhood. You have the right to appeal your property tax assessment. Look up the process on your county assessor's website. Find comparable homes, we call them comps, that have recently sold for less than your assessed value. Present your evidence. A successful appeal can lower your assessed value, which directly lowers your tax bill, which in turn lowers the amount that goes into your escrow account every single month. The second, and often easier, lever to pull is your homeowner's insurance. When you first bought your house, you were probably in a frantic rush and just picked an insurance provider to get the deal closed. You are not married to that insurance company. I want you to set a calendar reminder right now for 1 month before your policy renews every single year. The reminder should say, "Shop for homeowners insurance." Get quotes from at least 3 to 5 different companies. You will be shocked at the difference in premiums for the exact same coverage. Saving $500, $1,000, or even more per year is not uncommon. Once you find a better deal, you simply sign up for the new policy and inform your mortgage lender of the change. They will adjust your escrow, and your monthly mortgage payment will go down. It's one of the easiest ways to give yourself a raise. And that brings us to the final, most powerful secret of all. How to slay this 30-year dragon, this massive mortgage loan, not in 30 years but in 24 or 20 or even less. The secret isn't some complicated financial product. It's simple, relentless consistency. The secret is making 1 extra mortgage payment per year. That's it. Now, you can do this by just writing a check for 1 full payment at the end of the year. But a much more powerful and less painful way to do it is to take your monthly principal and interest payment, divide it by 12, and add that small amount to your payment every single month. Let's run the numbers because this is where it gets life-changing. Imagine you have a $400,000 loan at a 6.5% interest rate for 30 years. Your monthly principal and interest payment is about $2,528. Now let's apply the secret. We divide $2,528 by 12, which is about $211. From your very first payment, you decide to pay $2,739 instead of $2,528. But here is the absolutely critical part. You must specify to your lender that the extra $211 is to be applied directly to the principal. If you don't, they might just apply it to next month's interest. You have to be explicit. Every online payment portal has a box for additional principal payment. Use it. So what does that extra $211 a month actually do? On that $400,000 loan, it will pay off your mortgage 6 years and 2 months ahead of schedule. But it gets better. By cutting off those last 74 payments, you will save over $85,000 in interest. Let me say that again. Over $85,000. That's a luxury car. That's a full college education for your kid. That is a massive injection of cash into your retirement fund. All from the price of a nice dinner out each month. Why is this so powerful? It's because of how amortization works. In the early years of your loan, your payment is almost all interest. A tiny sliver goes to principal. When you make an extra principal payment, you are attacking the loan at its source. That extra $211 doesn't just pay off $211 of the loan. It eliminates all the future interest that $211 would have accrued for the next 20-something years. You are literally buying back your future month by month. And you don't have to stop there. Get a raise at work? Take half of it and apply it to the mortgage principal. Get a tax refund? Don't buy a new TV. Kill a piece of your mortgage. Anytime you get a windfall, make a lump sum payment towards the principal. Even just rounding up your payment to the nearest $100 makes a noticeable difference over time. This entire journey from checking your credit score to this very moment has been about one thing: taking control. You've learned how to choose the right professionals, how to navigate the paperwork, how to negotiate, and how to secure the best possible deal. But signing the closing documents isn't the end of the game. It's the beginning. A mortgage is the largest financial tool you will likely ever use. Most people treat it like a 30-year prison sentence. They just make the minimum payment and resign themselves to being in debt for decades. But you now know better. You know how to manage it, how to shrink it, and how to conquer it. You know that a house isn't just a place to live. It's the bedrock of building generational wealth. By choosing the right loan, managing your costs, and aggressively paying down the principal, you're not just paying off a house. You are building equity. You are freeing up hundreds, then thousands of dollars in cash flow. You are turning a liability into your single greatest asset. This is your future. You've got the map, you've got the tools. Now go build it.